All right, so goals for this webinar. I want to give you guys a simple approach to deal from a position of strength. I know the idea of saying, okay, how do I deal where I'm strong? It's a pretty simple concept. It is the actual execution of that people have to realize what they're doing. So what I want to talk about is how do you eliminate irrelevant stops in the market? How do you understand what makes you strong and what makes you a weak player? What makes you a weak holder? I use the analogy oftentimes, think about the home buyer. Think about 2005, 2006, 2007 in the home crash. Somebody that bought 100% cash was a strong buyer, right? Somebody that put 5% down or no money down back in 2005, they were not a strong holder. It's the same idea. It's what can you withstand? Where do you position? I'm going to show you my daily trade model that's generated over the last year consistent profits over 123,000. Now think about that. Somebody asked me, well, what dollar amount you basing it off of? In other words, did you start with 10 million and it made 123? It's not that impressive. Here's where the impressive part comes in. It's based on one contract, right? So if I buy crude oil, it's one contract of crude. If I buy euro dollar, it's one standard lot in euro dollar. It's 100,000. So it's actually very easy to follow along in terms of using it as a starting point. And how you can add that to your trading portfolio right now, right? You have to eliminate all these other things that just overwhelm you. So now you're asking yourself, is this for you? What are you in this trading world? Are you an experienced trader? Are you an investor? Yeah, this works for you. If you're an investor and experienced at what you're doing here, you'll see the value of determining the strength of your levels, of determining where you approach from. Maybe you have some experience trading. Maybe you have some profitability, some losses, and you're trying to go back and forth, but you're truly trying to find that pattern that works for you, that consistency that works for you. Maybe you're just newer to the markets and this is your first step in here. That would be awesome because I get so many people that have absolutely spent so much on education and are no better off than when they first started. And maybe you're just at this wannabe level where, hey, I'd like to be a trader, I'd like to be an investor, but I don't really know how to start. That's who it's for, so it's fitting. So goals for today. What do we want to talk about today? Want to show you this proven trade model, right, that you can add to your trading and to your investing portfolio right now. And you're going to see, I'm going to show you a different way to frame your charts with a very simple but effective approach to trading. I get this all the time from people that have joined my trade room, people that have paid for my analysis. And in one way, it's actually quite nice. In one way, they'll say, wow, this is so simplistic. And I say, yeah, it is. It's very simplistic. The whole idea of it's very simplistic, but there's a lot of detail that's the difference between being profitable or not being profitable, right? I'm going to walk you some of the real trades that I've done, and I'm going to show it to you on the charts, and I'm going to show you this daily trade model that gives you the framework for the consistency. Consistency is one of the key words that I hear from traders day in and day out of what they're looking for. They've never been able to establish it. So if you think about the idea of traders say, well, I've made money for 3 weeks in a row and then I lost everything on one trade. Well, that's not really consistency. It's a consistent pattern of making a little, making a little, making a little, lose a lot. That's consistency. So those are our goals for today. So this is interactive. I'd like you guys to ask as many questions as you can, participate, but stick around to the end in the cup of coffee idea. So the idea of the offer at the end, you'll see it's a cup of coffee a day, and that's something that's really exciting for me to take the financial stress out of it, so that once you're set up and working on this, you're not thinking about ongoing subscription or a monetary part to it. So let's get moving here. And this is, like I said, this is interactive, so make sure you guys participate, ask as many questions as you want. I'm going to be moving quickly. I have a lot to cover, but I think we'll be able to do it. All right, so first and foremost, who is this guy talking? Why do you guys care? What does it matter? Look at that mug. This is me. I'm MarkCoe. I'm nobody special, right? I started out just like you guys. Here's my story. I graduated Florida State University, 1993. I have a degree in international affairs. What does the market think of that degree? I'll tell you what the market thinks of that degree. It doesn't care at all. It did not get me a job at Goldman Sachs. right? I tried to get a job at Goldman Sachs. I couldn't even get into the first level of interview. My degree meant nothing. So the nice part about the markets, and I will tell you this, the market doesn't care whether you went to Harvard or you came from the street. It just doesn't care. All it cares is what you're willing to do if you participate. Certain jobs you may want to have some education to open a few doors, but you know, the bottom line is my degree did nothing for me in the markets. I started out after college, a lot of entry-level jobs, just bounced around. I didn't have any passion for anything. I didn't have any real path. Went and got a job at Morgan Stanley being a sales guy. It wasn't my cup of tea. It just wasn't for me. I was introduced by a friend to a firm on Wall Street that allowed some entry level if you would bring your own capital. It was a prop trading firm on Wall Street, and I convinced at this point, my unbelievably generous mother to let me get started as a prop trader, something I had no experience doing, and probably in hindsight she should have laughed at me and said no way. But my mom didn't. She believed in me and she let me have the opportunity. She gave me $50K to start with, and I went and took my money to Wall Street, and I thought, hey, this is my new career. And our agreement was, if I drop $15,000, if my account ever hits 35K, I'm done. And that was my agreement. That was my agreement with my mom. If I lost $15,000, I was done. I got down to the point where I was one day away. I was at $35,100, and I was about ready to have to close up shop. And I'd been doing it for a number of months, and at that point I said, look, I know what I'm supposed to be doing here. I just have to execute it. Enough with the fear, enough with the bad mistakes, just execute. And from that point, I made a turn. And the turn didn't go from 35 grand in one day to all of a sudden 50 grand the next. The turn was like this. It was 35,100, 35,300, up to 36,000. But if you can imagine the difference in psyche trading at 36,000 and all of a sudden having $1,000 of room versus, you know, $100 of room until you are out of this business, it was very different. It didn't take me long. This was the dot-com bubble. This was the late 90s. There was a lot of volatility in stocks. There was a lot of excitement, and I did really well. Inside of a year, I became the one of the top 3 traders at the firm. I was hired by the firm some months after this, so I got to give my mom back her initial capital. And so I was trading firm money, which to me was an entirely new, it was a new thing. I went from trading a $50,000 account to a $1 million account to a 3 million to a 10 million. So I grew quickly. But you have to understand, I didn't grow overnight. It was lots of little successes. And that's what I'm talking about, pointing yourself in the direction to be successful. In 2002, I founded my CTA, Commodity Trading Advisor, where I focus exclusively on foreign currencies. So I built my CTA. I started out with $400,000 in assets. I had 2 investors who each put in $200K. They were my initial backers. And I grew that CTA in 2002 from $400,000 in assets to $106 million at its peak in 2007. So I was managing $106 million in 2007. Well, 2008 occurred and those assets went bye-bye with a lot of different assets. I was not in long-term positions. Some of the people that had their assets could use them as liquidity for other bad investments. So just by the nature of the game, people were drawing from me, and a lot of you will remember 2008. It was a very challenging time where people were pulling assets left and right, and if you were liquid like I was, they used my assets, so my assets shrunk pretty quickly. But we've been able to bounce back and really done some great things. So I sold a trade model in the mid-2000s to a $1 billion hedge fund, and this is the same trade model I use today. So the same trade model I use today that's been enhanced and has been traded for a $1 billion hedge fund is what I use for my retail traders. And this is what you see over the last year. So these are the results based on one contract or one standard lot in FX. So what you'll see out of this October, November, December, there was one major event in the U.S. that was really a trend mover that was allowing positions like dollar yen, sterling yen, euro yen, and so there's some big outliers there. That was the presidential election and quite the melt up in stocks and move lower in yen. So you see that in late fall. But again, the consistency. the consistency that's going on. We may record, actually October, we may record the first negative month in over a year. So we'll see how October finishes. But at this stage of October, we're sitting with about $3,000 in losses from the month of October. So we still have 2 days, but we'll see how October gets recorded. But this is the trade model. This is what I traded for $1 billion hedge fund. This is what I've developed. This has been my life's work. So what about you? Thinking about it in terms of this, what if you can eliminate the stress, the frustration, and the time and just focus on your trading, right? So many people have so many stresses in life and they're trading, you know, they're stressed about 1 tick, 2 ticks. I heard the gentleman before and I thought it was just genius. He said, don't sit there and look at a 1-minute chart. There's not enough medication in the world. It's so true. All I deal with are people that have come from a background where they've somehow learned to trade these minuscule micro time frame charts, and they're just insane with what's going on in their head. And I thought, wow, it's finally so refreshing to hear somebody say it beyond me. You know, don't look at that; it'll just drive you nuts. And I just thought, kudos to him for saying it. What would it mean to your trading to finally have a complete, proven trading approach to build on? I started a new 50K program, which I'm going to talk about towards the end, but I have a lot of newer traders in here, and one of the first things I do is ask everybody to supply a trade plan. And you would be surprised how many people do not have a trade plan. Now, the reason that's so scary is you start to think about what happens when things go bad, and then you have to try and go in the moment and say, well, what should I do now? When you've planned on it and adjusted to it accordingly and say, okay, I know if I buy the S&Ps and they turn around, I know what I'm going to do. If I sell the S&Ps and they continue higher, I know what I'm going to do. But if you ask a trader in the heat of the moment, in the heat of battle, while they're watching their screen tick up or tick down to make that decision and to make a good decision, it's an unbelievable challenge. So think about it like this. I think one of the things that retail traders don't focus on, they're always so quick to make judgments. They're judging everything by tick, moment by moment, day by day. But they don't think about it like this. So in setting yourself up for a successful business, what if you could eliminate that one really bad common trade loss? And not just once, but what if you eliminate it over the course of the year? Right? That one trade where you say, well, I just held too long and I let it move against me, and so I made a bunch of $20 gains, $40 gains, $50 gains, but I have one $400 loss. What if you eliminate that $400 loss? Not in the 1 day or the 1 week, but over the course of the year. That $400 loss that keeps creeping up, and maybe it only creeps up once a month, but multiply that out times 12 months. Now it's not a $400 loss. It's a $5,000 or just under a $5,000 loss, right? But it's created with good habits. It's created with a trade plan. What would it mean to your business? Imagine if you're running, I don't know, it doesn't matter what type of business, but you have to look at trading like it's a business. The goal is to focus on those things that you can control, focus on those things that you do well. The things that you can't control, you don't need to focus on, but you need to be aware of them. But the whole idea is over the course of the year, what would it mean to your trading, right? Think about it from the standpoint of this. It doesn't sound like a lot of money. It doesn't. $250 a day over the course of the year. That's a $50,000 trading business. It doesn't sound like a lot, but $250 a day. You know, the idea is, I know you're not going to make money every single day. I know it doesn't work like that. But it's the idea of what it really takes. If you as a trader are so hyper-focused and you're saying, wow, I have a $2,000, $3,000 account and I have to turn it into $1 million by next quarter, you're not setting yourself up to be successful, right? So that's the idea. Okay, so let's talk a little bit about trading. It's what brought us together here today. This is what we want to focus on, the agenda. How do we avoid typical trade traps and eliminate irrelevant stops? Right? Remember I talked about avoiding those losses, avoiding those things that over the course of your trading year can have a big impact on your P&L. One of the things I did as a trader when I started out, I was looking at my accounts and I would review my trades every single day. I would review them and I would say, man, I lost $150 today, but I would go total up all the wins I had, and maybe of all the winning trades, and believe me, I was a very active day trader back in the day. Of all the winning trades, my winning trades would total something like $500, $600, $700, but I would still manage to record a net loss on the day of $150. So I started to think about it and say, well, look, I clearly make enough to record positive P&L. What if I can eliminate some of the mistakes? And so that's what I began to focus on. I was already doing something good in the winning trades, but now I needed to focus on the mistake portion, right? I needed to focus on how do I have as few of those as possible, and that's what really started to turn my trading around. All right, so number two, why cookie cutter strategies that aren't tailored to your trade plan and skill level, they're so dangerous to your trading. They create this emotional roller coaster, right? So many people that I talk to have experience with many different levels of education. They have different, strategies they may buy into. And again, kind of getting back to this idea of a trade plan, if you're going to take something and not really have a basis or a knowledge of how that would affect you, you're kind of not in a real strong position there. So what it means is, what if a really successful trader uses something simple like, I'm just going to use a moving average, and anytime we're above a 200-period moving average, I want to be long, and anytime we're below, I want to be short. That's a pretty basic plan. It doesn't include a lot about risk. It doesn't include a lot about stops, but I could tell you that that trade plan would want to be trend following in nature, and that's what it would be looking for. Well, if I sat here and showed you that trade plan and showed you a P&L that looked impressive, you may say, oh, I would like to run that. And then when the reality hits of the first loss, the second loss, the third loss, you're going to start questioning it. The time to question it is before you ever run it. The time to question is in your research of what you should be running and understanding how it would fit to you. The quick fix. The quick fix, this is the typical retail mindset. I need fast results, but I'm going to miss some ingredients, right? Everybody's focusing on the shiny object, the quick fix, the get rich quick, the get skinny without ever working at it. I got news for you. I don't mean to be a downer, but it doesn't work like that. People that are good at this, they spend a lot of time. The gentleman that spoke before me, I promise you, he spent a lot of time in front of those screens. He spent probably decades working at his craft. Same thing as me. I've been doing this since 1997. I didn't start yesterday. I have so much experience in this market, and I have two types of experience. Winning experience, I know what it's like to win, and losses. So I'm no different than you. I've been there before. I know what it's like to lose money. But the difference is how do we handle it? So think about it. Is this you? I need help. I'm suffering from trade strategy. I have too many indicators. I'm just locked in indicator hell. This is me a little bit, the bald guy, put my heads down. Total state of market confusion, right? I'm overwhelmed in this. Total state of it. This is what we're looking to eliminate, right? It's too much information. I can't tell you how many days in my live trade room I have people quote to me something they've read, something they've watched on CNBC or Bloomberg TV, and they'll say, hey, this guy just said such and such about the euro. I say, I don't really care. I don't care what they say. To me, there is one thing that's dominant over all of it, and that is the market. So it's somebody's opinion, great. If you want to trade somebody's opinion, that's fine for you. That's not how I want to live my trading life. I don't need information overload. I'm going to get on my charts here in a minute, and I'm going to show you how basic and simple my charts are. Remember in the beginning I said how people tell me, oh, your approach is just so simple. Oh, thank you. It is. So rather than spending tons of time and money that you don't have, and you still have nothing to show for it. That's a lot of people in the retail world. That's a lot of people. But you have to understand why that's that way. You have to understand. And it's not really your fault. And I'll show you why. I'll show you why it's not your fault. There's not a clear path for what it is you're looking to do, right? Everybody, all these cute little kids in this picture, would think about their path, right? The little nurse, she goes to nursing school. She gets her job as a nurse. The doctor, he goes to med school, gets his job working at a hospital. The fireman, he goes to his fire academy, right? There's a path. There's a path there. And think about what your path is. Think about what your path, or let's say this, lack of a clear path, right? It's very much like the entrepreneur. right? There is no set path. So you have to find that on your own, right? You're trying to find that on your own. What is your path? How do you get from this starting point? How do you get from this starting point of saying, I want to be a trader, I'd like to be a trader, but I don't know how to do it. I got a few bucks. Here's my charting system. Boom, I'm a trader, right? So we need to change that and say, here is your path. Here is how you get there. A proven path from a starting point to your end goal. And I would tell you this, it's not always about being an end goal, but it's a place where you want to achieve and you can grow from. So to do that, it's a simple 3-step approach. It's a clear path, right? It's a foundation of what you're doing, a foundation in your trading, a bias to give you that look in your trading, and then it's simply to be able to execute what your plan is. It's simple. It's a 3-step approach, right? It's a 3-step approach. So I'm going to show you that on the charts. So Jeanette, can I take over now, back the screen and pull up?
Yeah. Okay. We're going to make sure that and we'll come back to the PowerPoint when you're ready. But we're going to make sure that hopefully it's just a PowerPoint issue and not a screen share issue. All right. So you should be able to share your screen now.
Okay.
I would just shut PowerPoint down all the way.
Okay. I'm going to shut PowerPoint all the way down. Okay. Can we all see chart? It says dollar yen.
See your whole desktop and your chart. Yep.
You see it now?
Blowed up. I see it. Okay.
Okay, perfect.
Okay.
All right, so guys, talked a lot about this in the PowerPoint, trading from a strong foundation. Think about what I'm saying. So I'm going to use a few different examples. I know in my circles and in our trade room, we have a lot of FX specific people. I myself trade futures, stock indexes, FX. So I trade a lot of instruments. We have a lot of people that focus almost exclusively on FX, but I want to give a little bit of both. I don't want to show just FX, but I want to talk about what I'm looking at here in foundation. And I want to think about what I deem important in the market. And to me, I use what I refer to as levels. And levels give me what I want to know. The idea, you see how blank my chart is. I do have a MACD down here. I have a MACD at the bottom, which I like for a couple reasons, but not so much for trade decisions. But one, just in the 20 years I've been trading, I've always had one on there, so it breaks up the screen nicely. But it is a lagging indicator, and it's something that I will preview just for my eyes. I would tell you it's more of a vision thing than a use for my trading. So I want to start with this idea. So just so you guys all see, we have dollar yen. And I want to work dollar yen like this. So I'm looking at a weekly chart. And I want to give you a little breakdown and a little focus of how I look at charts. So I ask myself 3 basic questions when looking at the chart. I want to, yes, this BC asked the question, does this work for stocks? Yes, it doesn't matter what the instrument is. So you have to think about what my take on the market is. It's basic auction market theory, right? If anybody's ever studied market profile, auction theory, that's what the basis of what you're determining. So anything where you have a buyer and a seller, a decision is going to be made. And what is created is a level, and you can see those levels now on a chart. So anything I do on charts, I'm looking at it from a standpoint of who is in control of the market. So these are the 3 questions I'm asking myself. Who is controlling the market? At what points are they controlling the market from, right? That's what I want to know. How do I want to trade in that market, and where can I position from? So who controls the market? How do I want to be positioned, and where can I get positioned? So to come up with those answers, I have to look at it like this. I need some type of historical information. So let's just look at our starting point as 2012, and we'll carry forward here. So in 2012, if we're looking at dollar yen, this would be us in 2012, dollar yen. What do I have prior to that? I have what I would call a bottom edge. And when I refer to edges, all I'm looking for is consolidation. So that consolidation will require a bottom and a top. So markets can do 3 things. Think about it like this. Markets can trend higher, right? Price discovery higher. They can trend lower, price discovery lower, or they can go sideways. The market really doesn't have any tricks beyond that. It can mark price higher, it can mark price lower, or it can go sideways. So what I'm marking are sideways points, and I'm calling them tops and bottom edges, okay? Please center chart. I'm not certain center it to what, but let's kind of keep working through here. So what I'm looking at, bottom edge in dollar yen, and then I would create top edge. So when I ask myself the question, who's controlling the market? I have to be able to say, how is it entered into this area? Well, the sell side took it into this area, so sellers are now controlling the market. But where do they control it from? They controlled it from 85.35. Okay, perfect. So now at this stage of the game, 2010, I can mark this as a reference point in dollar yen. All the way giving me this as a frame of reference as I move forward. Right? This is my frame of reference. Can everybody see that okay? I'm trying to expand it so you guys can see it. So this frame of reference was created back here. So I have a top edge and a bottom edge. And so I'm asking myself the question, who is controlling the market? And I want to trade with the strength of the market. In other words, how I determine it, I want to trade with that side. And so when I talk about a foundational bias, what it means is I want to be sell side top edges. I want to be long side bottom edges. That's the foundational approach, right? There are times where bottom edge longs will make sense even if it's counter trend, but it makes sense. Why? Because of your risk versus reward is so in favor of you being long that you can handle the stop out portion of that and still justify it in your trading. So the idea is that when you're dealing at edges, you're dealing on some very powerful market information, right? This isn't a MACD, it's not a moving average, it's not any other indicator you want to come up with. It is the actual market that rotated away from this level. So that's the market. That's groups of buyers, sellers, and everybody that's involved in the market making the decision that they will not let it go above this spot, 85.90. And they rotated the market from 85.90 down to 76.25. So almost 10 big figures in dollar yen. What do you think happened the exact next time it rotated to the same level? So think about it in your trading. What would a lot of momentum look like? As that thing trades from 76 and all the way up, a lot of momentum would be chasing that and saying, well, clearly this thing's being bought, it's being purchased, it's moving higher. The market itself has already given you the answer. The market said, this is the level, we will not let it go higher. This is where sellers are located. All you have to do is position yourself accordingly in that area, which means short-sided trade with your risk being contained to a move above that. That's where you're wrong. So remember before in the presentation I talked a little bit about meaningless stops, right? Stops that have no relevance. And this is what so much retail focuses on. They look at a level and they say, okay, I understand the level and I understand what you're saying, but I can't really risk that much. So let me go ahead and I'll just sell a little here and I'll stop out just in front of that. And they run tight stops and maybe they repeat it 15 times. And those 15 times give them a total loss of 70, 90, 100 ticks. Then they get frustrated, and what they say to themselves is, this idea doesn't work, it's garbage. All the while, all the market did was rotate back to the same spot, trade it off, and now produced almost a 2,000 point gain, almost 2,000 points. And what do you have at the bottom now? Now you have at the very bottom the lows that were in there prior. Look what the market does at those lows. Right? Those are the lows. This is levels. This is nothing more than levels. There is no indicator package you need to purchase. There is no software you need to purchase. Every chart you have the ability to draw your own levels. And it's one of the things I'll teach you in my room, how I do it. But drawing that level, it becomes your reference point going forward. It becomes your reference point going forward. So think about it. The idea, sell side at top edges, buy side at bottom edges. Do you think you can make money in a market if you're positioning short up here? Do you think you can make money in a market if you're positioning long down here? I mean, you have to realize that's a 1,000 point move in dollar yen. That's a 800 point move in dollar yen. That's a couple thousand point move above it. So here's what you're trying to do. You're trying to consistently position yourself so that when you're wrong in a trade, your losses are very well contained. and you're trying to position yourself so that when you win, your wins are enormous. Do you remember when I talked to you about a trading model that I use, a trading model that I give to all my subscribers on a daily basis that's done over 120,000 in P&L, right? It's a longer term thing. It only executes at the end of business, at the end of the day. But this is the trading model. Let me show you a little bit what that looks like. Remember when I talked about the idea of small losses, big wins? Here's the actual P&L. Now these are based on one contract or one standard lot in FX. P&L, 49.50, 28.10, 5,000. Now I did say that this was a big time around the election, so there was some good volatility. But let's focus on some of the losses. I know you guys will look at the wins, and it is what it is. But let's focus on the losses. Here's a loss, $1,500. Here's a loss, $27. Here's a loss, $900. Here's a loss, $550. Here's a loss. There's a lot of losses in this month. $1,100. A loss, $900. Do you see the theme that keeps recurring within those losses? They're all really small and manageable. Now look at the wins. 1,600, 1,500, 17, 22, 24. How do I do that? Well, here I'm showing you how I do it. When I'm approaching long trade at an edge, I'm approaching that long trade at an edge with the idea that it can move through it and it can stop me out. It's fine to stop me out. I've accepted the loss. I will move forward after a loss, but I'm going to position myself. Remember the big thing I mentioned earlier was these meaningless arbitrary stops. And the idea of that is taken away once I will put a stop beyond where the market has been capable of pushing it. Right? So the idea in dollar yen, for me to be wrong on a short side trade here, why would I want to stop lower than where the market could take it? So if the market could take it to a high of 85.93, right? 85.93. Why would I want to stop anywhere below 85.93? It doesn't make me wrong. It just simply makes me early. It makes me itchy trigger finger, but it doesn't make me wrong. So I want to give the ability of the market to say, you can go higher, but I'm not stopping myself out when you do. Imagine the difference in your trading to use proper stop placement, what it's going to look like at the end of the year. Not in any one trade, but over the course of the year. Right? Think about it. Most of you guys are not trading weekly charts. You'd probably be much better served to trade weekly charts, but most of you are not trading weekly charts. You're trading things a lot faster. You're trading 5, 10, 15-minute type charts. It's the same approach, right? It's the same approach. It just means that you have to allow the market to dictate where you're wrong, not your risk apprehension with losing a few ticks. All your risk should be built on the fact that you can easily accept being stopped out, but you want to be able to do it at a point where you're wrong. So when I take my bias, when I create my bias and say, okay, I want to be short dollar yen, I'm going to be short dollar yen. I'm going to be short dollar yen at the edges. Perfect. Because if dollar yen's going to stop me out, I may risk $500 to be short here, and it may stop me out right above, and I'm wrong. What did I lose? I lost $500. But if dollar yen rotates from there down to there, what did I make? I'm probably going to make around $5,000 in this scenario, right? It's risk reward. Repeat it. Rinse, repeat. That's the idea. Put myself in a good position. So there's so many habits that people are coming into this game with that are so bad for your trading. And understand the levels provide you such an advantage of what it is you're doing. So let's look at a couple other markets. This is dollar yen. So let's walk through dollar yen really quickly. So the idea, top edge, bottom edge. Buyers hold bottom edge, sellers hold top edge. Who's in control of this market? The sell side's in control. What happens at the bottom? They get a false break, which I would call a rejection of that bottom edge, and the bottom edge is still intact. It fails to test top edge, fails to test bottom edge. So what that means to me is we're going to find a breakout sooner or later. You're finding higher bottom edge. You don't really have a lot of edge, but you have lower highs. Okay, the market finally breaks right here. Now who's in charge? Buyers or sellers? Buyers just won this edge that they haven't been able to get through in years. Who's now in charge of the market? Buyers. How do you want to play this market? If buyers are in charge, do you want to play it short or do you want to play it long? I prefer to play it long. Perfect. Play it long. Where's our next frame of reference? It's going to be in here. This was the last peak high. That's going to be our next frame of reference, right here. That was the last peak high. Actually, I apologize. It's going to be right here. That's the next peak reference. So we want to trade long side above 86. Imagine what your account looks like when you get positioned to trade your short-term 15-minute, 5-minute, 1-hour charts long side from 86 when that market goes 86 to 95. That's 9 big figures. What if you walk into work every day with a bias of up in a 9 big figure move? Do you think you're going to make some money? Do you think you're going to make some money in a, what is this, 1, 2, 3, 8-week uprun, 8-week uprun in dollar yen? Your bias is to the long side during the entire rally. What is your focus going to be? All right, look where the market's pausing. So this is the level. This is 90, 95, just under 95. Look where the market pauses, right at that level. Why? Because markets and levels have memory. Levels have memory. It pauses right at that level, 1 week, 2 weeks, 3 weeks. And then what was the answer? Who won this level? Who won the level? Only one side won it. Who won it? Buyers won it. Buyers won the level. Which way do you want to be trading dollar yen? Short side or long side? Long side. Where do you want to buy it? On pullbacks to bottom edges or breaks of top edges, pullbacks to those top edges. Those are the only places you buy it because that's what contains your risk, right? So what you're seeing up here, you're seeing a higher bottom edge develop. That's all you're seeing. So I will show you how to do this in my room. I will show you exactly how to do it. I can't give you the full-on lesson today, but I'm going to give you some bits and pieces. If you take away with this, you'll be able to see how it affects your trading. But who won this level? Buyers won it. I want tap backs into bottom edges. Here's the next battle. You see where the market pauses 1 week, 2 weeks, 3 weeks, 4 weeks, all pausing at this level. Who won that level? Buyers. They're not able to hold it right now, but they won it. They won it. Which way do you want to trade dollar yen? To the long side. Where do you want to trade dollar yen from? Bottom edges. So this is the level, right? This level was marked in June of 2009. The same level, June of 2009. Carry it over. Do you think June of 2009 to 2017 is enough time for you to get prepared to deal on a level? 8 years, I think so. It's the same level. It wasn't created in June of, or in 2016 or 2017. It was created in June of 2009. That's when the level was created. It's the same level. Buyers won it. Buyers couldn't hold it, but you're still in a balance area. Buyers are still holding bottom edges. Who wins it? Who wins it in November of 2013? Who wins it? Buyers or sellers? Buyers. Which way do you want to trade this market? Long or short? Long. Where do you buy them? Bottom edges or breaks of top edges, pull back to them. This is your former top edge, which is now becoming bottom edge. Longs into this edge. Longs into this edge. Longs into this edge. Is it surprising that the buyers are controlling the market and it goes higher? Is that surprising to anybody? No. Why? The buyers showed you they're in control, and they showed you back here. This is where it was questionable. This is where they broke it to take that control. That was 85. You haven't had a sell bias since 85. What's the next level? I have to keep going left to scroll. The next level is above 110. Okay, let's see what happens at 110. How does it go? If my levels are not meaningful, how does it go right to that number? I mean, look, this is where it's coming from, right? In the summer of 2008. The summer of 2008. Now here we are in October of 14, some 6 years later, and that's where it pauses. Are you kidding? I mean, are you kidding? You've only had 6 years to diagnose that level. And what's the reaction from that level? 110 down to 105, 5 big figures. But let me ask you this question. Did buyers ever lose control? Did buyers ever lose control? They never lost it, did they? So which way do you want to trade dollar yen? I'll ask again, which way do you want to trade dollar yen? In a market where the dollar yen buyers haven't lost control, which direction do you want to trade dollar yen? Do you want to trade it long or do you want to trade it short? Is that convincing enough? It's not me telling you, it's the market showing you. This is why I tell you, I don't care about anybody on CNBC. I don't care about Bloomberg. I don't care about their analysis. They're not participating. This is the market. These are central banks, hedge funds, billion-dollar asset managers that move markets. And this is what they're telling me. Who are you going to listen to? So all I'm saying is line yourself up with some strength here. Understand what it is you're looking for. The market is telling you what to do. You then need to go execute it. But you need to have your plan, you need to have your bias, and understand what it is you're doing. When I said before, you're looking for former top edges or bottom edges to be long. This was a top edge. Pull that across. Look how tight that area is. That was a top edge. That was a top edge. That area is 40 ticks wide in dollar yen. That's all you have to do is buy the pullback to it. You're not chasing the market. Why would you chase the market? You don't need to chase the market. There are plenty of markets to do your analysis on. This takes 1 week, 2 weeks, 3, 4, 5. 5 weeks to pull back. Look what level it held. I mean, it traded 105.23 inside of your 40-point zone that was diagnosed in December and January of 14. This trades back to that 10 months later. 10 months you had to be prepared for that level. And look what happens when you put your money to work at that level. I mean, are you kidding? That's 105 to 121, 16 big figures all by doing that work. It's unbelievable, right? It's amazing, but it's not me. It's the markets have memory. I will show you how to do all of this, but it's the markets that are making the decision. You guys want to look at it on another chart? This is dollar yen. What other markets you guys want to look at? I'll take the first one I see. It doesn't matter. It works on stocks. It works on DAX. It works on crude. It works on gold. What's the first one I see? You guys are going fast now. Let's do futures. Let's do gold. Are we having fun yet? I love Saturday mornings. Jeanette, will you just give me kind of a heads up when I need to slow down and get back on the thing, because I'll go all day, and so.
Yeah, totally. I've already got people asking me how to follow your trades. So maybe in a minute you can share your offer, and then you can go back to taking.
Okay, so let me just do gold. Yeah, let me do gold really quick, and then we'll get back to the offer sheet, and then I just want to show you guys the offer, and then we can play with charts here and till you guys are done. Okay, so gold. So same thing in gold. So I'm going to go to a point prior in history, and what I'm looking for is I need a reference point. So where I'm going to start. Where am I going to start the analysis to say that somebody's in charge and somebody is stronger than the other side? Okay, so this is perfect. So top edge. This is gold. Just so you guys hear, I'm write it up here just so you guys can see it. These are gold futures. This is the continuous contract. And let me just put it up in a little bigger. There we go, gold. Okay, so here's our gold chart. So I have top edge, bottom edge. So there's my consolidation. What would I like to do? I'd like to be short at the top, long at the bottom, right? So think about the trade that's occurring in here. This was the former top edge right here. It's now bottom edge. Okay, so look how many trades are available at this bottom edge, which was it was a top until it was taken out here. Once it's taken out, it is now a bottom. It's a former top edge. Okay, there's trade right back to it. I mean, I couldn't make this stuff up. It's trading back to the tick, right? This is $30 on a weekly gold chart. This is 1538 to 1569. Prices contained right in there. Rallies from 1538 to 1800. $270 rally. You want more? It's right back to the same level again. Now all of a sudden it doesn't quite get 1800. It trades just shy of that, so you don't get your full 280. You get like 260. So you're starting to see less of a reaction, but it's still tradable, right? 280 bucks, 260 bucks. You want more? Third time. This one matches this. So you see what's happening here. You're creating lower top edges. So now you have a tradable edge. Longs, short, longs, short, all within a consolidation. Longs again. Are you going to survive in this long? No way. You're going to get stopped. Can you pay for a stop here if you have 250, 250, 250, 250, 250, 250? Can you afford one stop? Of course you can. Of course. But let me ask you this question. Who won the battle right here? This was the battle. This was a June to 11 to June of 2013 almost battle. Who won it? Who won this battle in gold? Which way do you want to trade gold? Which way do you want to trade gold? If the sellers won it, which way do you want to trade it? I'd like to trade it short. How can I trade it short? At top edges or breaks of bottom edges tap back to them. So to define a top edge, I have to find consolidation, right? Here's a break. If it taps back to 1530, I can sell it. It's this edge. But I'm now looking at this new consolidation. Okay, there's one opportunity right here, and here's bottom edge. So this is what tells me I want to be short. Break lower. Now it's starting to form. Now it's a reaction. Sell side. Sell side at 1400. 1400 rotates back to this exact level. That's a $210 move in gold. All with the idea that I have the bias correct because the sellers told me. I didn't use the guy on Bloomberg TV. I didn't read some news report. I let the market tell me what it wanted to do. That's all I did, right? Sell side. If you want to go counter trend, where would you go counter trend? At the bottom edge. If you have $200 of risk, would it make some sense if you want to play counter trend? Sure, but just do it at the bottom edge. Doesn't mean you only have to be a trend follower, but just do it at the bottom edge. Understand this is counter trend if you're looking long, but this is still a $200 move. I like to focus on the dominant side, meaning I like to focus on sell side. Sell side, what's happening now at the bottom edge? Something's happening at bottom edge. Your reactions are not taking you back to the top, are they? They're failing up right here. They're failing to go all the way back. Right here, they're failing to go back. Who wins this battle? Who wins this battle? The same side that won the battle here. How do you guys want to trade gold? How do you want to trade gold? Long or short? You want to trade gold long side or short side? Where are you going to get short gold from? Top edges or break of bottom edge, break bottom edge, break bottom edge, tap back right here. This is a move back into this edge. It's a perfect short right back into that edge. Boom. There's a next move right back into it. It doesn't hold. So you'd pay a stop on that one. Can you afford, don't think for half a second you will not be stopped out with this methodology. Of course you will. But here's the difference. Just like I showed you on this spreadsheet of the model, which is much slower acting, those losses are going to be really well contained, right? 1500, 900, where those gains are going to be much bigger. That's the whole basis of what you're doing. But you see how the levels, level, it's trading level to level, right? It's trading level to level. So it's what makes it so clear when you're going in there. You can throw out every other indicator. Just throw them away because they're so confusing to so many people. The levels provide clarity, right? The levels, look at what happens in gold. Watch. The sellers win it, tap back, which means you sell again. It rotates. There's some money to be made there. That's a $150 move in gold. What happens once it gets back above this level? It's the same level. What happens once it gets back above it with the failure to extend the downside? You can use it to lean on long, right? So you would pay a stop. If you sell this, you would 100% pay a stop by having it go back above and close. But once it does, you will now use that edge for longs, only at the bottom edge. Long opportunity, long opportunity. Up to where? Up to this edge. That's all you're doing. You're trading edge to edge, level to level, right? That is this edge right here. That's it. That's it. Makes sense? All right, Jeanette, do you want to go ahead and put the offer up, and I'll answer some questions while we're going over it. So let me tell you guys quickly about the offer.
Yeah, let me add it back up. Let's see. My brain isn't on. Okay, here we go. Let me make myself the presenter. And then when you're done, you want to go back to charts. I'll just give it back to you.
Sure.
Right there.
All right, guys. So here's what we're offering, and I wanted to do this. I think it's quite spectacular, and I'll tell you why. I think about a lot of the things that hurt retail traders, a lot of what people get hung up on. People don't like necessarily having monthly subscriptions. I wanted to remove that. So here's what I'm offering. All for what I think to be a very reasonable cup of coffee a day. Remember in the beginning I had the little, the cup of coffee. $500 for the next 12 months to sit in with me live in my trading group, in my trading room, to allow you to watch this stuff being done live. You will get the daily model, which covers 11 markets. You will have futures. You will have foreign exchange. You will have live commentary every morning, Monday through Friday. We do live 8:30 a.m. trade brief. You have me live throughout the day. There is no trial period. This is a very special offer we did for the TradeThirsty group here. It's called the Peak 50K Trade Challenge. Now, this is my personal challenge to produce 50,000 in real P&L, not leverage P&L, real P&L, which you guys will get to see every one of those trades taken live. Again, the big difference being that, you know, not in hindsight and not with just analysis, but actually taken live. So what we've done is we've offered a $500 price to be able to sit in for the next 12 months. You're not worried about money at all after this. You're done for the next 12 months, and we can concentrate on trading itself. So we get our model, the daily trade model, which is updated every day at 5 p.m. Eastern. The close, I'm using the close at 5 p.m. New York time. I do two shorter term reports, one that focuses on foreign exchange, and those are prepared the night before. So that means for Sunday evening, you will get your FX report, which is for the whole next 24 hours into Monday. And then I prepare a U.S. Open report that is focused on futures. So it's crude oil, gold, E-minis, NQ, copper, and nat gas. So we have a daily trade model, again, to talk about this foundation, something to work from, right? There are a lot of traders that have not had the ability to even know what to do and what path to follow. And so I'm giving it right off the bat, saying, look, you can create your own trade plan, but in lieu of anything else right now, I'm at least giving you something historical and something proven to work from, right? This is the model that $1 billion hedge fund paid for. So it was good enough for them. It's what I use. It's a basis. It's a starting point. And so understand you can go back and look at each one of the trades that the trade model has covered, and it's produced with one contract, again, not taking $1 yen position and multiplying it times 50. It's taken one contract or one standard and come up with that P&L in the last 12 months. So the idea is that there is something there for you to be able to follow while you learn, to be able to speak on a daily basis, to be able to ask me questions, to be able to see it done in real time and be able to be a part of it. So that's what the offer is today. You see standard pricing is a lot more expensive, so the yearly subscription would be over $1,700. You're welcome to come in and do a monthly if you would like to see a trial. We do offer $149 a month, but we're offering this today to this group, $500 for the year, and then you're done. You're not thinking about those funds anymore, and we're on to the trading, we're on to the analysis, and working from there. So somebody asked with the question, with a 50K goal, how much do you start with in your trading account? You're definitely over 20, but I have multiple accounts I trade. So the way I look at it is this, and the idea, I think I understand the questioning. The idea is, what would somebody need if they wanted to reproduce it? And I'll just give you an example. In the model trades will often risk something like $800 to $1,200 in terms of what risk would look like. You have to decide in what your capabilities are in putting that risk to work. The shorter term, some of the swing trades, some of these shorter term trades, they're based solely on what the risk is, and they will have a stop. For example, say you're risking $400 on a stop. The stop would be built depending on how far away it is to your position size. So I think here would be a reasonable question. If the question is something like this, would you like to take each trade that I trade, knowing that if I hit 50K, you're going to hit 50K? Well, I would just tell you out of absolute fairness, if you were trying to do that with $2,000 to $3,000, you would be stretched really thin, and it would probably not be likely. If you were sitting under $10,000 or $15,000, it could be tough to take the exact sizes I take. It is not tough to take the exact trades I take. You would just have to adjust the sizes. But then again, think about it like this. The idea is if your whole goal is to make this a successful endeavor for you, don't worry about hitting 50K. Worry about hitting 1K. And then once you hit 1, worry about hitting 2. Once you've hit 2, worry about hitting 5. You can't think so far down the road. It has to be small, successful steps that get you there. The trading room hours, I'm usually in the room by about 7 a.m. Eastern. We do the morning brief at 8:30 Eastern. And then I'm in there all day, and I shut the room down probably about 9 p.m. Eastern in the evening. Can we trade stocks, ETFs when we don't know how to trade FX and futures? I guess you're asking, can you trade what, stocks and ETFs based on currencies or just in general? I mean, you can trade any instrument. You have the ability to trade any instrument. The analysis doesn't change how you do it. You know, the morning brief itself is anywhere from probably what, guys, 30 to an hour to go over what's going on that day. We do a weekly education every Monday. So Monday is education day. We do a recorded education session every Monday. So again, it's really, really unbelievable value to be able to think you're going to get 52 education sessions, live trading, a trade model. But we record everything. I don't necessarily record little, you know, comments here and there, but anything that's structured or education is always recorded. So you always have access to your recordings. You always have access to the briefings afterwards. Yeah, it's, I mean, Thinkorswim, I mean, you can trade any platform you want. You guys see what I'm looking at. I don't use a lot of indicators. I'm using the price, and I'm using reaction to the price. So, you know, the whole thing, what you think about when I showed you some of those big moves, if you understand who's moving the market, big money is moving the markets, right? Big asset managers, central banks, large hedge funds, they're directional in their play. You have to think about it from the standpoint, what is a day trader doing? A day trader is sitting there, oh, I want to take a few ticks, or I'm looking to take a few bucks. A day trader is not directional. A day trader is looking to take a few bucks out of the market and be done. The big money that will keep pressing, keep adding, buying into dips, looking for a move higher, they're directional in nature. They are directional and looking for an actual move. So what we're trying to do is line up with that direction and think about, you know, we talk about so many things that are stacked against the retail audience. Well, this is one of those things that's actually in your favor. Right? You don't have to commit the same time and capital that big money or big positions do, but it's a huge advantage to you to be able to say, look, big money is doing this with the market. They're playing the market long. They're playing the market short. Whatever it is they're doing. You know, so the idea is that you want to constantly trade from that position of strength. So when you think about dollar yen, I just showed you this chart in dollar yen, and I went back to 85 in dollar yen with the move up to 110. If you had the idea, look, I want to be long dollar yen, and you watch dollar yen trade from 85 to 100 to 105, and you just said, I can't stand it anymore, I'm going to play long dollar yen, and you finally decided to play it at 110, well, what happened to you? The first move off of 110 was what? 500 points against you. What was the next 1,500 points? It was straight up. So imagine that move on a daily basis is what the retail trader does, right? They can't stand it. They react to the momentum. Here's what I'm showing you that's different. You're still saying, I want the long side of dollar yen, but the difference is, where will you buy it? And the reason you'll pay 105 is because you're leaning against a long-term level. That's the whole difference. So I hope you guys take this opportunity to join us. Like I said, this is going to be limited, but we are offering it today. We did it with this in mind, that it was a very fair, reasonable price to be able to get people in for the next year, because I don't want people in their quest to turn their trading into success, to build for the future. I don't want you sitting there thinking about some absolutely, handcuffed approach where you have to pay me every month. It's not about that. It's one and done with the payment, and then you got 12 months to go and, grow as a trader, really see your potential and watch what that money can actually do. Watch how it can grow.
All right. Do you want to go back to some live charts? Check your questions box and answer some questions.
Sure. Whatever. Are we okay on time? I mean, I'm the last speaker, right? I mean, is there any certain time you would like to be done, Jeanette? No,
maybe we'll just go for about another 10 minutes, and then I'm going to do a trade challenge with them and give them some money. So people that stick around for that.
Sure. Give me the charts again.
Okay. All right. Let's see. I'm going to make you the presenter.
Carl, yes, absolutely you can. Okay, show my screen. Okay, can everybody see screens?
I see it.
Okay, perfect. All right, so let's get back to questions. Let me see. Okay, so just what I was talking about here with dollar yen. Here, let me just get back to this dollar yen so I can point out what I was talking about. So I mentioned, imagine you're in dollar yen and you say, I want to be long of dollar yen. I want to be long of dollar yen. I can't stand watching this price go higher. I can't stand it, right? I want to be long down here. Dollar yen trades from 85 to 105. And finally, at this stage of the game, you say, I can't watch it any longer. I'm going to buy it. And what happens? It pulls right back. But if you back up and look at the market and say, well, where did it really pull back to? It pulled back to the last prior edge. Oh, really? That's what it pulled back to? And you're selling a stop, you're hitting stop and letting the market take your money because of that. That is what you're going to stop doing today. Not a week from now, not a month from now. That move is going to be stopped today because you realize what it is you're dealing against. You no longer have to take those edges and ignore them. Now you understand the value of those edges because, again, it's not me telling you, it's the market telling you. The market simply said, I will not go lower than this. And so your choice is, you can ignore it or you can execute and make some money. What do you want to do? I'd rather execute and make some money, right? And so it's not as though every other form of analysis is thrown out the window. If there are people that like to trade fibs, there are people that like to trade fibs in conjunction. Here's the thing about it. A level is a reference point, but it's a solid reference point. It's a solid reference point of what the market wants to do at any given area. And so if you can constantly go into the market risking 1 to make 7, how many trades do you actually need to do to make money? But if you go into the market risking 3 to make 1, boy, you better be perfect more than 9 times out of 10 to really make some money. So ask yourself this question. Do you want to take an approach that either makes you almost have to be perfect, or do you want an approach where there's a lot more room for error and you're still going to make money? I'll give you a question I ask a lot of people, and most retail will answer it the same. And just think about it like this for a minute before you guys answer. No, I trade FX, I trade futures, so I trade both FX and futures, Lee. If you had 2 trading systems that both produce the exact same P&L, right? So the P&L is the same. They both make, let's say they both make $50,000 over the year. But one of those trade systems won 70% of the time last year, and it made 50 grand. The other one won 30% of the time last year and made 50 grand. Which of those 2 trade systems would you pick to trade the next year? If you have a choice, they both make you 50 grand in profit, so your net profit is exactly the same. Would you prefer the one that won 70 last year, or do you prefer the one that won 30 last year? Which of those would you prefer? I'm just waiting for some answers. One person says 70, 2 of you wrote 30. Would you prefer to win 70% of the time? Okay, now they're all flowing in. So 80, somebody wrote 70, of course. 70, of course. Okay. Most of you are answering 70. Now, don't take any words like commissions. It's just straight P&L. What the question is One of them wins 7 out of 10 times, one wins 3 out of 10 times. And let me explain it to you with what you guys are thinking. Most of you guys are answering 70. Here's the thought process. If you take something that, wouldn't you guys agree 7 out of 10 is, it's darn near perfection? It's really good. It's really good, right? It's darn near perfection. What if darn near perfection doesn't happen this year and it wins 6 out of 10? It's not going to do so good, is it? What if the 3 out of 10 has a slightly better year and it wins 3.5 out of 10? What if it just takes that slight shift? 3.5 out of 10 and the 7 goes to 6.5. Who's going to win? So the idea for it to happen, doesn't the 3 out of 10 winners, don't those winners have to be enormous compared to the losses? So you guys, a lot of you that are answering 70 are taking the thought process of typical retail. And I'll ask you this, how does typical retail perform in the markets? You would be happier winning 7 out of 10, but you're not asking the correct question, which is, well, of those 7, how many of, like, what are the winners? If I win $1, does that count as a win? But if I can lose 7 out of 10 times and 3 of those makes me 50K in P&L, that's pretty impressive. That's pretty impressive, because what that means is I can lose $50, lose $50, lose $150, make $1,500. Somehow I got to my 50K, but if I'm doing it with 7 out of 10 are winners, then that means those winners aren't that big. So it's a thought process, and you have to understand that you have to start to get away from that thought process in retail trading, because there are a lot of things that are stacked against you, but there are also a lot of things in your favor. You just have to take hold of the ones that actually can make you strong and forget about the ones you can't do anything about. You know, the big difference is so many people focus on things they can't control. What I'm looking at is, here's what I can control. I don't know if the market's going higher or if the market's going lower. I don't. But I know where I'm willing to deal. Right? Somebody asked the last, was it Larry's the last presenter? Whoever the last presenter was, somebody asked him what his thoughts were in the S&P, and he said, which I love the confidence, the unequivocal, we're going lower. Listen, we may go lower, we may go higher. I'm shocked every day we don't go lower, but we don't. So here's the point. I don't know which way the market's going, but I do know where I'm willing to sell the S&P, and I know where I'm willing to stop myself out, right? I love that answer that he gave, because it wasn't hedged. Like if you listen to people on CNBC, most of them will say, well, I'm long-term bullish and I'm short-term bearish, and they hedge themselves because they're so afraid of being wrong. Like he wasn't afraid to be wrong. He may be wrong, he may be right. I don't know. But I like that kind of confidence. That stuff is good to me. Like I love listening to him, you know, and I can't say that about most people. I don't have an enormous opinion of many people in our, you know, business, but man, when you hear the ones that you do, you like it. So, yeah, I mean, it was great. Like, I enjoyed it. So it was good stuff. All right, guys. Well, I know I'm getting to the end of the day. Thank you guys so much for your participation. Thank you for listening. I hope to see some of you guys in the room. I think we've created a great offer here for you. I'd love to see some of you on Monday when we start. And if you guys have any questions, let Jeanette know. And I'm always available if anybody has any questions for me. Thank you guys so much. Jeanette, thank you. It was awesome. I had a blast. I hope I can do it again.
All right, excellent. Thank you so much. We're glad you got to spend this time with us, and we'll call you a second timer.